The first time the system rejects you, it rarely feels personal. The email is polite, brief, automated. We regret to inform you, maybe it's an apartment, maybe a car loan, maybe an insurance policy that somehow costs you 3 times more than your coworkers, even though you've never crashed a car in your life. At first, it feels random, bad luck, bad timing, maybe inflation. Then it happens again and again. Slowly, a strange realization begins to form. There is another version of you living underneath your real identity, a silent version, a numerical version, one that banks trust more than your face, more than your words, more than your work ethic, more than your actual life. And unlike you, it never sleeps. The number that decides your life. A woman applies for an apartment in Chicago. She earns enough money, no criminal record, no evictions. The leasing office never even meets her. An algorithm does. 32 seconds later, she's rejected. No explanation, no conversation, no appeal. Just risk. Not human risk, statistical risk. Because somewhere inside a server farm, hidden behind corporate firewalls and proprietary formulas, the system believes she resembles people who fail, not because of who she is, because of what people like her have done before. A man walks into a dealership. The salesman smiles warmly until the financing screen loads. Then something changes. Tiny shift in posture, tiny pause. Suddenly the conversation becomes smaller. The enthusiasm disappears. The car he wanted quietly evaporates into other options. Not because he's dangerous, not because he's unintelligent, but because a score has already estimated the probability of his future behavior. And increasingly, modern society treats probability as truth. This is not just about debt, or banks, or personal finance. This is about something larger, something quieter, the construction of an invisible reputation system that now determines who society trusts before society ever meets them. For most of human history, trust was local. People trusted faces they recognized, families they knew, communities they grew up inside. Your reputation lived in memory. Then industrial society arrived. Cities became too large. Banks became too distant. Commerce became anonymous. And anonymous societies have a problem. How do you trust strangers? Credit scores emerged as an answer to that question. Not a moral answer, a mathematical one. At first, the process was surprisingly primitive. In the early 20th century, lenders used handwritten notes to describe borrowers. Honest, unstable, drinks, reliable wife, immigrant family, poor character. Human judgment compressed into paper files. But human judgment had limitations. Humans are emotional, inconsistent, biased, expensive. Computers promise something colder, cleaner, predictive. By the late 20th century, financial institutions realized something unsettling. Human behavior is shockingly predictable at scale, not individually, statistically. Millions of people leave behind patterns, payment histories, late bills, defaults, income fluctuations, spending habits, and eventually those patterns become models. Then models become infrastructure. Then infrastructure becomes destiny. Your score is not really measuring morality, it's measuring predictability. That distinction changes everything. A credit score is often described as a financial health metric. That's misleading. It's closer to a behavioral confidence score, a system attempting to answer one question: how likely are you to behave in ways the institution prefers? Think carefully about what this means. The system does not care if you are kind, or intelligent, or honest. It cares whether your future can be predicted with acceptable certainty. Miss a payment, and the system notices. Open too many accounts, and the system notices. Carry high balances, close old accounts, apply for new credit too quickly. The machine watches all of it, quietly, continuously. What makes this powerful is not the score itself, it's the automation surrounding it. Once a score becomes machine-readable, entire industries can make decisions instantly. No human conversation required. And once enough institutions automate trust, the score stops being financial. It becomes social architecture. Insurance companies may interpret lower scores as indicators of higher claims risk. Landlords use them to estimate tenant stability. Employers in some industries review them during hiring. Banks use them to determine not just approval, but pricing. Two people can borrow the exact same money, yet one pays dramatically more to exist. Not because they are poorer, because the system believes they are riskier. And risk has become one of the most expensive words in modern civilization. High-risk people often pay more for nearly everything. More for borrowing, more for insurance, more deposits, more scrutiny, sometimes more humiliation. And here's where the system becomes psychologically disturbing. Because once someone is categorized as unstable, the penalties themselves can create instability. A rejected apartment application leads to temporary housing. Temporary housing disrupts employment consistency. Employment instability affects finances. Financial instability lowers trust scores further. The loop tightens. The algorithm does not hate you. That's the unsettling part. Hatred would imply emotion. This is colder than hatred. Indifference. A machine does not wake up angry. It simply continues calculating. There's a moment many people experience without realizing it. A moment when they stop feeling like citizens and start feeling like applicants, constantly applying for housing, for financing, for trust, for access. Their life becomes an endless audition for invisible systems. And increasingly, those systems are not designed to understand context, only correlation. A medical emergency looks identical to irresponsibility on paper. A divorce can resemble financial instability. A layoff can resemble unreliability. Grief does not translate into spreadsheets particularly well. The system does not ask, "What happened to you?" It asks, "How statistically dangerous are you now?" Something strange happens when human beings know they are being continuously scored. They begin modifying behavior around the score itself, not necessarily around reality. This already happens in social media. People optimize themselves for algorithms, thumbnails, hooks, engagement metrics. But financial scoring creates a deeper psychological effect because survival is attached to it. A person with a low score may begin avoiding opportunities entirely, avoiding applications, avoiding risk, avoiding movement. Not because they lack ambition, but because rejection becomes exhausting. Over time, invisible scoring systems can alter identity itself. People internalize the number. They begin speaking about themselves through the language of risk categories. Good credit, bad credit, prime, subprime, as though human worth has quietly merged with actuarial terminology. And perhaps the strangest part is that many people never actually see the full system judging them. Only fragments. A number here, a denial there, an interest rate, an unexplained approval. The real machinery remains hidden, protected as proprietary logic. In older societies, power announced itself loudly. Kings wore crowns. Governments built statues. Modern power often hides inside interfaces, tiny numbers on glowing screens. Credit scoring was never the final destination. It was the prototype. Because once society accepts automated financial trust, other forms of automated trust become easier to normalize. Behavioral analytics, fraud prediction, consumer scoring, engagement ranking, systems observing patterns to estimate future behavior before it happens. In some industries, algorithms already determine whether transactions appear suspicious, whether customers deserve additional verification, whether behavior matches expected patterns. Most people never notice, because the infrastructure operates silently, and silence is important. Visible control creates resistance. Invisible control creates adaptation. People adapt remarkably fast to systems they cannot negotiate with, especially when those systems control access to stability. A person denied by another human being may argue. A person denied by software often feels strangely powerless. Because how do you reason with probability? How do you persuade a statistical model? Increasingly, modern civilization is shifting from relational trust to computational trust. Not, do I know you, but does the system validate you? And once enough of life depends on machine validation, people slowly reorganize themselves around machine legibility. You begin performing stability, curating predictability, avoiding behaviors that trigger friction. Even your financial life starts resembling surveillance compliance. Don't move money strangely. Don't miss patterns. Don't appear volatile. Don't confuse the machine. It sounds dystopian. Until you realize most of it already exists. There's a particular loneliness attached to financial scoring systems, because the judgment feels invisible. And invisible judgment creates paranoia. Was it the late payment, the collections account, the utilization ratio, the hard inquiry, the medical debt, the old eviction? The algorithm rarely explains itself clearly, so people begin guessing, obsessing, monitoring. Entire emotional states now orbit numerical trust systems. Relief when the score rises, anxiety when it drops, shame when rejected, validation when approved, and slowly, something profound changes. Approval begins feeling moral. A high score starts resembling virtue. A low score starts resembling failure. Even though scores often measure exposure to hardship as much as responsibility. A person born into financial instability may spend decades paying algorithmic penalties for surviving unstable conditions. Not because the system is evil, because systems optimize for efficiency, not mercy. And efficiency without mercy becomes psychologically brutal over time. The future may not arrive through dramatic authoritarianism. No marching boots, no giant speeches, no obvious moment where freedom disappears. It may arrive softly, as convenience, automation, optimization, risk management. A civilization where human beings are continuously interpreted through invisible predictive systems, where trust becomes numerical, where identity becomes behavioral data, where access depends on algorithmic confidence scores most people barely understand. And perhaps the most unsettling part is that these systems often work, at least statistically. That's why they spread. Predictive systems reduce uncertainty. Institutions love reduced uncertainty. Investors love reduced uncertainty. Machines are extraordinarily good at finding patterns inside human behavior, sometimes better than humans themselves. But there is always a hidden cost when societies become obsessed with predictability, because the people hardest to model are often the people most capable of transformation. The recovering addict, the bankrupt entrepreneur, the immigrant rebuilding from nothing, the divorced father starting over, the woman escaping financial abuse. History is full of people who looked statistically dangerous right before rebuilding their lives completely. Algorithms struggle to measure redemption. And maybe that's the real tension underneath modern credit systems. Not finance, not debt, but philosophy. Whether human beings should be understood primarily through their patterns or through their potential. Tonight, millions of people will open banking apps before they sleep. Some will feel relief. Others will feel dread. Most will never meet the systems quietly evaluating them, the systems estimating their future, assigning confidence levels to their lives, calculating who deserves trust and at what price. And somewhere inside those silent calculations, modern society is slowly deciding what a human being is worth.